Thank you, Raleigh. Again, my name is Shane Handy. I am the founder of therationaltrader.com. This is a somewhat unique educational service designed to teach you to trade in a very controlled, very methodical way. I'd like to thank you for joining me tonight. We're going to talk about the 3 challenges all traders face, and those challenges are based upon a core understanding of human nature, which I call market biology. I'll define that for you shortly. I'd like to say a quick thank you to TradingPub for hosting us today, and also take the opportunity to recognize all of the people involved behind the scenes that you never see but are absolutely essential to putting something this complex together and having it run so smoothly. So Raleigh and Yana and Cam, thanks to you and your team. Now, often during these kinds of presentations right here at the beginning, you're subjected to 10 minutes of background on the speaker. I'm not going to do that right now. There's actually a better place for it later on in the presentation. But what I will say here at the outset is I'm a trader. I run a live trading room. I trade with real money, live, in front of people every day. I have a very clear understanding of what it means to be a trader and what it takes to learn how to trade. Now, the nature of today's presentation is such that you should just hold questions until we get to the live charts. And at that point, we'll get interactive. Let's begin with this observation. There is an often cited statistic that 95% of all new traders lose all of their money within a year. 95%. Now, I haven't seen the data, so I can't independently verify it, but my own personal experience bears this out, as does every conversation on this topic with every broker I know. 95% of all new traders lose all their money within a year. So think on this next statement during our discussion today. If everyone is failing and you want to succeed, you have to do something different than what everyone else is doing. If you want to succeed where everyone else is failing, you have to do something different than what they're doing, because what they're doing isn't working. The question is, why is the failure rate so high? I'm going to share with you what I believe is the answer, and we're going to talk about the root cause of that failure and what you can do about it, moving from the general framework for success you need to have in place down to specifics, including what elements need to be present in your trade setups. Now, before we continue, there are 4 aspects to any discussion of trading that you need to be aware of. I suspect many of you have seen this many times before. I would request that you not tune out. I have a very specific take on these items that relates to our discussion today. The first is risk. Trading is risky. You can lose all of your money. You can even lose more than your initial investment if you're dealing with any kind of leverage. And in fact, you are likely to lose all of your money. We just talked about that statistic. One of my goals at therationaltrader.com is to teach you to trade, or to help you to learn how to trade without losing all of your money in the process. Next is suitability. Trading is not for everyone. A trader experiences on a daily basis a level of emotional intensity that is simply not part of your average person's daily routine. It's not for everyone, and you may find that it doesn't suit you, and the sooner you know this, the better. Third is performance. Past performance is not indicative of future results. This statement is almost a cliche, but it's true. It's just not true for the reason you think it is. We'll talk about this today, but I'll tell you now, 2 people can be following the same trading methodology, executing the same trading system, and one will be profitable and the other will not. There's clearly something more at work than just the trading system. Fourth, hypothetical or simulated results are not to be trusted, especially if they're given to you by someone that is selling you a trading system. These results are often produced with the benefit of hindsight. And I promise you, if you give me any data set, I can craft a profitable trading system from it because I already know what happened. More importantly, there's no risk in a simulation or a backtest, and risk is the most important factor in trading, more important than anything else. Risk is the reason one person makes money but the other does not, even though they are executing the same trading system, because they each handle risk differently. So a simulated result then is not very useful, since it's missing the most important element. I'll take this one step further and tell you, don't even trust actual results. The financial markets are littered with the corpses of traders who had a great track record until the day they didn't, because they didn't understand the risks they were taking and did not have appropriate measures in place to protect themselves. It doesn't do you any good to turn a profit if you can't keep it. The stories are legion. You never hear about the small account traders who blow up their accounts, but you hear about the big ones. My favorite is the emerging market bond trader who made $40 or $50 million for his bank over the course of a few years and then lost $600 million in a week because he didn't understand the risks he was taking and he didn't protect himself. Any methodology you employ to trade the markets must include solid measures to protect your account for the times when the market does not do what you expect, including protecting your account from yourself. And with that statement, we segue into why nearly everyone loses money. One way to approach this question is to look at what everyone else is doing and don't do that. Another way is to look at what they aren't doing, but what they should be doing. And it turns out it's the latter of these two where we find our answer. Now, when people start trading, they begin by learning technical analysis of the markets. Bar charts, tick charts, moving averages, oscillators, stochastics, etc., etc., etc. And this is important stuff. There's a basic foundation of technical knowledge that is necessary for you to have in order to understand what the market is doing. But notice that I said what the market is doing and not why the market is doing it. This is the first challenge you face as a trader, figuring out what technical method you're going to use. And here is where everyone runs into trouble, because everyone focuses exclusively on learning technical analysis, thinking that this is the primary skill needed to be a successful trader. And it's no surprise they think this. There are hundreds of indicators out there and an endless array of ways to use them. And everyone is talking about all the different ways to analyze the markets. So to a newcomer, it looks like this is where you need to focus your attention. It's perfectly understandable. But this is where everyone falls down. The beginning of understanding why nearly everyone loses money is this. Technical analysis of the markets is an intellectual activity, but trading is not. Technical analysis, it's a logical thought process. It uses the puzzle-solving part of your brain, the cognitive functions, the frontal lobes. It's an intellectual activity. But trading, actually placing a trade with real money on the line, real money, your money, at risk of being lost is not an intellectual activity. A different part of your psyche is involved, a part that has not been developed by your efforts at learning technical analysis. You can be an expert analyst, but still be an infant trader. Technical analysis, it's a mandatory skill. You must have it. But it's not the only skill you need to be successful as a trader. And when you're developing your technical analysis skills, you are not developing the skill you need to actually trade with. Remember, everyone is talking about the technical analysis of the markets, but everyone's failing. So if trading isn't analytical or logical, well, then what is it? When you have something of value at risk, your body reacts the way nature intended it to. And it doesn't matter what's at risk, only that you care about it. And the more you care about it, the greater the reaction you'll experience. If someone or something tries to harm you, your body automatically, autonomously reacts. And we call this the fight or flight syndrome. If there's a threat to your child, say your toddler steps out onto a busy street, your body reacts and you leap into action to save your child, even if it's not a busy street. I'm talking as the father of 3-year-old twins. Those two are like herding cats. This response, it's physical. It's a physiological response. It's in your biology. It's not intellectual. It's not rational. It's glandular. It's also autonomous. You have no control over it, and in fact, you don't want to control it. It's an important part of your survival mechanism as a human being. But it's working against you as a trader, and I'll clarify why in a moment. Your body does not make a distinction between a threat to your life, a threat to your child, or a threat to your livelihood, or your reputation, or your ego. It doesn't understand there's a difference. It reacts the same way, regardless of the type of danger you're in. When you have something of value at stake, your body responds. And the greater the value you place on it, the more intense the response. When you place a trade, you have money at risk. You value that money, and your biology responds. This is a perfectly natural reaction. But it doesn't stop there, because you actually have much more at risk than just money, much more. We need to talk for a moment about why you're trading. Most people are trading because they want to secure a better future for themselves and their loved ones. When you strip away everything else, this is what you find. You want to provide for your retirement. You want to provide for your child's college education. You want to have to worry about being able to provide for them because of the economy or your industry or the decisions our political leaders are making. Freedom from worry or control over your own destiny. So beyond the money that's at risk, this is what's at stake. And this is what your biology reacts to when you place a trade. All the hopes and dreams you have about being successful in the markets are now tied to this trade. All the fear, anxiety, doubt, excitement, greed, euphoria, all of it is amplified and concentrated down into this one moment in time. And this happens all day, every day when you're trading. You can see the fear in the market almost every day as traders bail out of positions that are killing their accounts, and the excitement as traders chase a market up or down. Both behaviors are in reaction to a biological response, and both are losing propositions. And now we've arrived at why nearly everyone loses money. The vast majority of traders make decisions rooted in their biology, in their basic human nature. They're acting in response to excitement or as a means to alleviate their fear or anxiety. And the markets have evolved to take advantage of this. They've evolved to take advantage of human nature. This is the reason why nearly everyone loses money. There is a Darwinian process underway. It's been going on for many, many years, and by this point in time, it's honed to a razor's edge. This is what you're jumping into. And if you don't understand what's really going on, if you don't understand the market dynamics, underlying why prices move, then you're going to fail. It makes perfect sense when you think about it, because trading is a zero-sum game. There is a winner and a loser. You are in competition with every other trader out there, and everyone is trying to take money from everyone else. The money that you make is not created out of thin air. It comes from someone else's account. For you to make money, someone else has to lose money. It's more useful to examine that statement from the other direction. For someone else to make money, you have to lose money. This is competition in its purest form. Now, obviously, you don't want to give your hard-earned cash to some other trader. So they have to trick you into doing the wrong thing. Or stated another way, the market has evolved ways to tempt you into doing something foolish. And it does so by preying on your natural biological reactions to having something of value at stake. In order to be successful as a trader, when you are most afraid to do something is when you most need to do it. And when you are most excited is when you most need to be cautious. Think of your account like a baby you're holding in your hands. It's precious. Protect it. The vast majority of traders make biology-based decisions in response to fear or excitement. If you want to be successful as a trader, you have to make dispassionate decisions that are based on data, not driven by emotion. You want to be on the other side of the traders making these emotional decisions. They are the ones succumbing to the siren call of the market, providing you with the opportunity to profit. Think about it for a moment. Who is taking the other side of your trade? Every trade has a buyer and a seller. Who's on the other side? Is it a newbie chasing the market, or a professional trader who's been patiently waiting for this setup all day long? Who do you want that person to be? For that matter, who do you want to be? The predator or the prey? because that's the kind of relationship you're in, whether you like it or not, and you're either one or the other. People new to trading spend all of their time and energy on navigating through the maze of countless technical analysis methods and no time at all on mastering their biology. They're unable to effectively implement their technical method because a different set of skills is required to actually trade in the face of their natural biological reactions to the market action. This is why your actual results don't meet the expectations from your analysis, and it's why nearly everyone loses money. This is the second challenge you face as a trader, mastering your biology. The question is, how do you master it? Even better, how do you get the biology working for you instead of against you? Now, one of the things you hear or have probably heard is that you need to be more disciplined, or you need to follow your plan. This is basically useless advice. It's useless because you already know it. Of course you need to be disciplined and follow your plan. In fact, if you don't have a plan, you're going to fail. And you get bonus points if you can tell me the movie that this image comes from. The problem is you're not a computer program. You can't just change a few lines of code and recompile. You can't decide at an intellectual level to behave differently and expect your body to follow suit. It just doesn't work that way. Think of a friend who's struggling to lose weight. Telling them to eat less and exercise more is useless advice. Your friend already knows this. He's probably irritated you keep telling him something he already knows. Much better, friend, how to structure his life so he eats less and exercises more. This is what we do at therationaltrader.com. Through a combination of business planning and capital allocation, which is really risk management, trading plans, live trading, and partnering, we show you how to structure your trading so you can master your biology and develop the discipline you need to be a successful trader. And we're going to spend the next few minutes talking about how you go about mastering your biology. What we're talking about doing is retraining your body. Your body is a biological system, and there's only one way to retrain a biological system, and that's repetition. It is the only way. You must repeatedly experience the situation you're trying to learn and execute the required actions under conditions as close to real as possible. Repetition in a safe environment is the only way to retrain a biological system. I'm going to give you two examples from other walks of life and then show you how we apply this so you can learn how to trade. The armed forces and the martial arts are two good analogies. In the Army, a soldier must be trained to perform under the stress of battle, and the Army prepares them for this through endless repetition, drill after drill after drill. They'll put you through basic training, and you'll come out the other side able to field strip a rifle while riding a bicycle blindfolded through a riot. The martial arts are similar. Now, I have a black belt in a Japanese style of karate called Shito-ryu. I was an instructor for many years at the main dojo in Southern California. In fact, many of the concepts implemented at therationaltrader.com have their roots in the martial arts. In the martial arts, they'll teach you how to block a punch. They show you what to do technically, how to make a fist, where to meet the attack, what's the angle of your arm, how to step out of range, etc., etc., etc. And then they have someone try and hit you many, many times. The first time you're basically terrified, your body reacts the way nature intended. But through repetition, the fear recedes. And after blocking the 100th punch, it's routine. After the 500th, it's downright boring. And it's the same thing with trading. By the 100th trade, it's routine. And by the 500th, it's so automatic, you don't even think about it. It's like tying your shoes. You just do it. The challenge for you as a new trader is to get to the 100th trade with your account intact. If you can get to 500 trades with your account intact, you are well and truly on your way. Now, I'm going to tell you a story that illustrates this need for two sets of skills, the technical skill and the biological skill. In the martial arts, we do something called kata, K-A-T-A. It's a Japanese word that translates to form. And what it is it's a sequence of movements that you use to practice your technique. There's probably 50 or 60 of them in my style. And they range from the very basic for the beginner to very advanced. And you use this to practice your technique and to ultimately demonstrate your mastery of the technique. Now, it's important to understand you're doing this by yourself. No one's attacking you while you're doing it. It's just you practicing these prescribed set of movements. Now, there are people who are simply amazing at performing kata. You watch them and they execute the technique with poise and grace, speed and power. The precision of their movements it's awe-inspiring. But they couldn't beat me in a fight. Now my technical capability was simply average. You get someone who's an absolute master of the technique, and you put on gloves and get in the ring, and they can't win. They could not beat me. And many times, it wasn't even a contest. Now, I'm not saying this to boast, but simply to illustrate the fact that you can be technically excellent, but if you can't implement it, you're going to fail. So it's a completely different game when someone's actually trying to hit you. And this is the same thing in trading. In trading, we have this technical component. It's technical analysis. It's an intellectual component. In the martial arts, it's physical. They're both the technical component. They both have this need to master the biology. In the martial arts, when someone's actually trying to hit you, it's much harder to do what you're supposed to do. In trading, when you put real money on the line, it's much harder to do what you're supposed to do. This is the epiphany that I had after the standard years of pain and suffering learning how to trade, is that the skills that are needed to be successful as a trader are identical to the skills that you need to be successful in the martial arts. So, our goal then is to get you to your 100th trade with your account intact. So if you take 2 trades per day, that's 10 trades a week. We're talking about roughly 10 weeks. That's your first checkpoint. Get 100 trades under your belt while keeping your account intact, then stop and evaluate how you're doing. What we're doing here is, in a very controlled way, allowing you to experience enough trades and enough market action to beat the fear, anxiety, doubt, excitement, greed, and euphoria out of your system. What you're doing is you're retraining the biological system that is your body. You need to experience the fear, anxiety, and doubt that comes when a trade sets up and you need to enter the market. You also need to experience the anger when the market stops you out, and the frustration when the market takes off without you, or worse, and this is the one I hate the most, when the market just barely stops you out and then turns and moves in the direction of your trade. In other words, there are times when you need to act to enter the market and times when you need to wait for a signal. Both scenarios generate a biological response that you must experience and process. Your job is to still do the right thing no matter what you're feeling. It's very hard to do. It gets easier over time. What you learn over time at a deep level is that there's nothing to fear. There is no danger here. And that physiological response, that biological response, lessens to a point where it no longer affects you. If you put it into perspective, it can help. When you realize at an intellectual level that this trade is just one trade. It's one trade out of the 500 trades you're going to take this year. That's 1/5 of 1% of the trades you're going to take this year. It may be profitable, it may not. It does not matter. We only enter the market when we believe the probability has shifted in our favor, so we know it will work out for us in the long run. The key is that you protect your capital. The key is to build the trust in yourself that you're going to follow your rules. You're going to protect your capital. In order to set yourself up to succeed, you need to structure your trading so that you can build that trust in yourself. To do this, you need 3 things: an environment where you can experience what you need to safely, an understanding of what you need to do technically, and a guide or a mentor or a teacher to show you the way and help you stay on the path. At therationaltrader.com, we've created a program that implements these elements. The guide is the live trading room. The technical understanding is the trading plan which is executed live in the trading room. And the safe environment is the set of rules that define your risk and how you'll protect yourself. Let's talk for a moment about setting up a safe environment to trade in, because for learning to trade, it's the most difficult element to deal with. In the armed forces, they will teach you everything you could ever possibly know about that rifle, but they don't give you live ammunition while you're doing it. In the martial arts, they employ gloves and pads to avoid injury. In trading, a safe environment is one where you cannot damage yourself too badly if you make a mistake or lose control of yourself. This equates to taking a small loss rather than taking a large or catastrophic loss. Now, it's quite a bit more challenging to set up a safe environment for trading than it is for the armed forces or the martial arts. And the reason is you must have real money on the line or you're wasting your time. You should trade on a simulator only as long as it takes you to learn the trading software and your trading system. On a simulator, with nothing at stake, you are not developing the primary skill you need to be successful as a trader. With nothing at stake, your biology is not engaged. This is why people do well on a simulator and lose money as soon as they switch to real money. Since you have to have real money on the line, you have to be trading in live conditions. Live conditions means you are trading against professionals. It also means you have to wait patiently for a trade to set up before you can practice your trading skills. Now, I can't think of another case that's like this, where you have to learn in a live environment against professionals who are not your friends. It's one of the reasons it's so hard to learn to trade. Imagine learning a martial art with a trading partner who's a professional fighter who's trying to knock you out. This is the third challenge you face as a trader. There is no practice environment. You must trade in live conditions. This is one of the reasons it's so hard to learn. You're trading against people who want you to fail. You're learning with people, with partners who want you to fail. They'll take all the money you'll give them. It's also one of the reasons that it is such an inefficient process, since you have to wait in live conditions for a trade to set up before you can practice your trading skills. One of the key elements of the program at therationaltrader.com is creating a safe environment to trade in while you're learning. I do this in what I call the business plan, which is the puzzle piece in the upper left corner. Normally, I would spend time here talking specifically about how we set up that safe environment, but I don't have time today because I want to show you specifically the concepts we're talking about. So if you're interested, I encourage you to visit the website and click on that business plan puzzle piece. It will give you more information about how you can get to 100 trades with your account intact, what you have to do to set yourself up for success. How do you create a safe environment to learn in? We're going to talk about trade setups next, but before we do, let's summarize why nearly everyone loses money. The primary reason is because of a fundamental misunderstanding about what skill they need to learn. The secondary reason is the fact that they have to learn in live conditions. People new to trading spend all of their time and energy learning technical analysis methods and no time at all on mastering their biology. Technical analysis is a logical thought process, but trading is not. Trading, actually placing a trade with real money on the line, real money, your money at risk of being lost, engages a different part of your psyche, and a different set of skills needs to be developed to actually trade in the face of your natural biological reactions to the market. Now, the trade setups that you use need to incorporate this understanding of market biology. You are struggling to deal with your natural biological reactions to having something of value at stake. So is every other market participant. And when we say the market, what we mean is all the traders who are trading that instrument. That's the market. It's a bunch of people, all of whom are subject to the same biological reactions to the market action we've been discussing. Human motivations and emotion drive the market. Fear, anxiety, excitement, greed, euphoria. Your goal as an aspiring trader is to work through the biology-based issues within yourself and recognize those same issues being expressed by the other market participants and then use them to your advantage. When you do this, if you think about it, what you're doing is you're now targeting yourself. You're targeting the trader you used to be as you become the trader you want to be. Now, let's go back to that slide with the sumo wrestlers for a moment. This is a pretty accurate representation of the situation that you're in as an aspiring trader with a small account. And you're not the big guy. You're that little guy. And if you engage in this fight, you are going to lose. Now, what you often hear is, don't fight the big guy. Instead, figure out what he's doing and do the same thing. That's actually quite difficult to do for a couple of reasons. The first is, the big players, they try and disguise what they're doing because they know you'll front run them. The second reason is they have a much larger amount of capital at their disposal. And so they can easily withstand just normal price fluctuations that will stop you out, even if you figure out what they're doing and get the direction right. Another approach then is to find one of the little guys and compete against him. Find another little guy and even the playing field. So instead of looking at this with just two players, think of 10 or 20 big sumo guys and hundreds of little guys. An approach you can take is to find another little guy and compete against him. It's one of the more interesting things about trading is that you get to choose your opponent. When you develop or evaluate a trade setup, you want to know what aspect of human nature is being taken advantage of. How are the market participants reacting to the action? And is there an edge for you? What is the person on the other side of your trade thinking? This is the key. What is the person on the other side of your trade thinking? You want to find the situations where the person on the other side of your trade is absolutely desperate or foolish. You want to find the emotion in the market and take the other side. Find the fear and panic, the excitement, and calmly and rationally take the other side. This is how you succeed day after day, week after week. Don't get so caught up in the technical aspect of trading that you forget about the person that's on the other side of your trade. That person is really important to your success. Now, by way of demonstration, let's go over an example that you see every day in the markets. So consider a group of professional traders trading moderate to big size that see the market advancing, and their assessment, right or wrong, is that the market will continue higher. So they want to get long, but they can't go long at the market. They drive the price up and just get a terrible fill. They know that the likely outcome, the probable outcome, is that the market will pull back for reasons I'll describe in a moment. So they identify where support is, and then they place their orders or prepare to buy below support, and then they wait. In the meantime, newer traders chasing the move out of excitement and fear of missing out have been buying. And what happens next is the traders that got in early, they start to take profit. And the price advance stalls. This selling pressure drives the price down. The newer traders that chased the market up out of excitement and greed and fear of missing out are now taking losses and getting stopped out. At least the smarter ones are, the ones that are using stops. This adds further selling pressure, driving the market lower, pushing the market lower. And what you're seeing here is basic reversion to the mean price behavior. You see it every day in every market. Consider any chart. When you look at the peaks and valleys, at the peak, someone was buying, a lot of someone's, and they all lost money. When the market breaks support, two sets of sell orders are going to execute. The first are the stop orders for the traders who are long. Some are protecting gains from an earlier entry, and others are the stop losses for the newer traders who got caught up in the excitement and chased the market up and bought at the highs. Those people are feeling some pain. The second category are sell stops for new entries short. These are mostly inexperienced traders who are shorting the break of support. Now, new traders like to enter on breakouts. It's a very seductive trade. And note the word seductive. It's the market tempting you. It's easy to see the trade set up and identify where the entry is. It's also a trade that can run nicely and take no heat. And newer traders are forever looking for trades that take no heat because they have trouble dealing with their fear when the market moves against their position. Unfortunately, the odds are against them because this is a low probability trade. The majority of time, they're going to get stopped out just on normal price fluctuations as price thrashes around at support, or in a complete reversal if this turns out to be a standard pullback into an ambush zone. Which brings us back to our professional traders. They're still out there waiting to buy below support. They're like spiders who have spun a web and are now waiting for a fly to come along. The market breaks support and those two sets of orders execute and drive the price down into the professionals' orders. These orders get filled, absorbing all the selling, and the market bounces up on the strength of all the buying pressure found below support. As the market advances, the newer traders that shorted the break are now getting stopped out, which adds fuel to the advance and the market doesn't look back. What you're seeing here are the market dynamics of a standard ambush trade, something you see all the time in the markets. When I look at this chart, I see two places to enter. At the peak, the market is moving up strongly because people have gotten excited and chased it up, and other people who got short have had to cover. They can't take the pain of their loss anymore, so they're bailing out. Keep in mind that as that market was advancing, people were selling, thinking the market was going to go down. When it doesn't go down, they've got to buy to get out. You want to wait until the last exhausted, pain-racked short has covered, and then wait some more for the people who got excited by the market action and chased the move up and bought at the highs. Wait for the last of the fear of missing out crowd to buy, and then step in and take the other side. This is a perfectly reasonable place to short, and it would not be unusual for this to be the high of the day. Now, the other entry is at the valley of the pullback, taking advantage of the natural ebb and flow of the market that we just discussed. Wait for the longs that were late to the party to cover, and then take the other side of the people chasing a low probability break of support. Now, let's look at this on a real chart. What I'm going to do is go through a particular day in a somewhat scripted fashion. So let me switch out of the presentation to the live charts. What you're seeing here is July 29th for the E-mini S&P 500. Let's get oriented. This is the chart I trade with every day, but I've removed some studies in order to make the point I want to make. This is a Sierra chart, or actually it's AT charts, which is a Sierra chart that's been directly integrated with Infinity Futures trade execution software. On the left here is the open. That's this green line. That's 6:30 Pacific or 9:30 Eastern. I'm on the West Coast, so all these times you see listed on the bottom are Pacific time. On the right, way on the right, is a red line that is the close. That's 1 o'clock Pacific or 4 o'clock Eastern. Now, other lines you see here are 7 o'clock, when there's often news, 10 o'clock Eastern. And then this is 9 o'clock or noon Eastern, the magenta line here, when I'm generally done for the day. This is the end of the morning session. I also have a blue line here at noon Pacific, 1 hour before the close, so 3 o'clock Eastern. You see, this is a range bar chart. It's 4 ticks high, so every bar is 4 ticks high. There is a Keltner channel applied. This is the green line is the midline, and the purple bands are the upper and lower band of the Keltner channel. That's a 30 period length for those of you that are interested. And the ATR on the bands is 1.5. Now, these gray areas are highlighted to help you remember to stay out of the market 5 minutes after the open. It's a little too wild right then. Or 5 minutes after there's news. Same thing. When there's often news. So I have the software automatically draw these lines and highlight areas for me. If we scroll back and look at what it looked like as you came into the day, this is what you see. There's been a big advance off the lows of the previous day, and then the market continued to advance overnight. Okay. So when you come into the day, what you have is you immediately break the overnight high. I'll explain the other two studies that are on there in just a moment, okay? And then you set this level right here. Now I want you to ask yourself, who is buying right up here? Who's buying up here? You just nicked the high. Do you think a professional trader is buying right there? Now, a professional trader is basically defined by the fact that they buy low and sell high. That's how they become professionals. A professional that doesn't do that doesn't last very long. And so, by definition, you can tell the market is nicking the high. The pros bought down here, or down here, or even back here. They're probably taking profit now as you're nicking the high. Now, there's an indicator here, a study, AT chart, CR charts calls it a study, that gives you some extra information to help understand that this is something that you're interested in shorting. This little cross here, it's a cyan color, light blue colored cross right here. You see another one here, some down here. These define reversal patterns. They're candlestick patterns that I developed that show that price is reversing. I suspect I'm not the first person to have figured that out. And what the study does is it draws that cross for you, that plus sign for you, in the cases where it identifies that price is reversing when you're outside the band. So when you've gotten far away from the average. So down here is a better example. You're very far away from the average. If you can get an entry down here, then even if the market is going to continue lower, you have a very good shot at getting back to the midline. This is just part of that natural ebb and flow of the market, that natural ebb and flow that's governed by human behavior. Okay. In the case of the first trade that sets up here, you nick the high and then show reversal with that signal right there. So this bar right here is showing you reversal after nicking the high. This is a great short setup. You nick the high by a few ticks. The entry is actually, let me get rid of this stuff here. The entry is right there with a 4-tick stop above the highs. And it catches this beautiful move down. Now, let's also talk about this other study that's on here that is outlining the bars in either bright green or bright red. This is using the ticks to identify a strong push up or down on the ticks. And when we see that, if we see a strong tick push up, we color the bar. We're looking for excitement. We're looking for fear and panic. If you see a strong tick push up, price should be going up. If the ticks are going up, the ticks are the number of stocks that are advancing versus declining on the exchange. If the ticks are going up, this price should be going up. This is the E-mini S&P 500. It is a broad market instrument. So if the ticks are pushing up strongly, price should be going up. If it's not, then you're looking at excitement and you want to get short. Here, if you've shorted here, you also can use this particular study as sort of a continuation indication. Because at this point now, you can see you've gone bright red. You rolled over, and now you've got bright red, strong tick push down, and price is closing down. I would use this as a place to add if I see this. My entry's up here. All right. Now, we talked earlier about when you're most afraid to do something is when you most need to do it. If you look at that chart, that does not look like the market's going down. And yet, that's the best entry. The market falls pretty hard. You get a nice bounce here. And then the same dynamic happens again. You set a level right here. Okay. Now, ask yourself, who's selling down here? Who's selling down here on this break of support? Do you think the professionals are selling down here? Very unlikely. Particularly when you look at what you see here now. You see fear and panic in the market, excitement in the market as the market's going down. All right, you break support and you show signs of reversal right there. Okay. This is a great short. Your expectation is that you're only going to get to the midline and it's going to continue, it's going to roll over. But that's enough to get you to at least first target, to get you to scratch. And you often find, as you did up here, that that's the low of the day. So here, when you take this trade at the highs, when you short it, you're paying close attention to how it acts when it gets to that midline. That midline is the average. It's the place where the natural ebb and flow of the market would seem to take over and you would continue higher. So if you see signs of support there, you are getting protective. Depending upon the number of contracts you're trading, you're taking something off. It's the same down here at the low, or what looks like the low at this point in time, is that you're getting, if you're able to get a good entry, you're not always able to. If you're able to get a good entry, you have a good shot of at least getting back to the average before the market continues lower. And in this case, again, you're paying very close attention to how the market behaves when it gets to the midline. In this case, it just blows right through it. All right. So now, let me get rid of all this. You actually get another setup here. All right. So let's focus your attention now on this area right here. So the market's advanced pretty strongly off this low. You're now well outside the band. If this is the new direction, right, a move back to the midline would be perfectly normal. All right. So you're interested in shorting. What you get though is basically a gift from the trading gods, because you've shown signs of reversal right here with this signal, and then on excitement you break that resistance level. The bars go bright green, the ticks are pushing up strongly, but that bar is closing down. You want to get short here. You want to find a short entry. All right, you get a formal reversal pattern after that right here. Okay. So you're looking to get short in here. Happens. And your expectation is, again, I'm far enough away from the average that all I'm expecting is to get back to the midline, and then I'm going to watch what it does. If it finds support, otherwise, I'm just going to let it go. So in this case, you fall all the way through to the other band, all right? And so the typical stop management here is you wait to see that signal, and then you wait to see another reversal pattern in the direction of your trade, and then move your stop. Okay, this is really key to understand. When you're getting in at the edges, when you're getting in at the turns, your goal is to let the market work for you now. And it's very hard to do because people see profit and they want to take it. They're afraid of giving it back. So that fear response is back in play now. And so it's very important that you have very rigorously defined trade management rules. All right. And the trade management rules that you have need to understand that the market moves in this natural ebb and flow. Okay. And so if you shorted at the highs, then you want to identify the start of the retracement that you're fully expecting. Okay. You want to identify that point. So if you have a reversal pattern, then that helps you identify that point. You're then looking for the end of that retracement, which I define as another reversal pattern, which you get right here. Now you're not getting, the indicator is not drawing a little plus sign for you because you're not extended beyond the band. But one of the key things we teach is, what do these reversal patterns look like? All right, so you'd move your stop there, and the way, if you just follow that logic, you end up moving your stop here. Whoops, wrong one. You end up moving your stop here, and then you move it to here, and you basically are just dragging it down. You end up actually catching this entire move here because you close at the lows. Okay, so the method to identify the turn is rigorously defined. That's your trade setup. The method to manage the trade is also rigorously defined, because as a trader, you have to fall back on your trading plan in order to deal with that emotional response that you're feeling, that fear response, that biological response. So in the same way that a soldier falls back on his training in the stress of battle, you as a trader have to fall back on your trading plan in the stress of trading. And so everything has to be as rigorously defined as possible, so that when you want to do something, you're basically not allowed to do it unless your plan says that it's okay. And this is what we do at therationaltrader.com. Everything is extremely rigorously defined, because in order to develop the discipline that you need to be successful as a trader, you have to know what to do. Your goal then is to try and do it. All right, but in order to do that, you have to have predefined what to do. This concept comes from the martial arts. In the dojo, the instructor, the sensei, he shows you, this is what you do that. And it doesn't matter that there are 15 other ways that you could achieve the same result. That's not the point. The point is that you can do what you are supposed to do in the heat of battle, in the heat of trading. Rigorously define your entries, your trade setups, rigorously define your trade management. All right. And then what we do at The Rational Trader is we specifically focus on dealing with that fear response and techniques to help work through them. Now, I want to show you one other thing before we move on here. I simplified what we show here. This is the chart I use every day to trade with. I trade the ES. I also trade gold and oil, GC and CL. I should just do this. One of the things I turned off were the pivot points. So in the ES in particular, the pivots are very useful. The pivots help you identify areas of support and resistance. So if you have a mechanism for understanding what the market looks like when it turns, then if you can identify support and resistance, it helps you to focus in. All right, so in our first trade, we actually have 3 elements that are helping us see that we want to short the market. All right, the first is that you see a strong tick push up, but price is not advancing. Price is it actually shows signs of reversal, right right here, it shows it immediately. R1. It shows it immediately. Right here, it shows signs of reversal. All right, that's the first indication that things are not well with the market going up. Then you nick the high, okay. But I now put on the pivot points. This is the daily pivot is here in the middle. These are the floor trader pivots. And basically what the pivots are, it's a very simple mathematical calculation that recognizes that the markets move in an ebb and a flow. The markets revert to the mean. So it's reversion to the mean on a larger time frame. So R1 is up here. It's very common to run into resistance at R1. So when you see I've had an extended run, I've got a strong tick push up, I just nicked the high and roll over at R1, this is a very, very solid signal to short. You'll notice also that we basically closed at S1. And we found support at the pivot. And again here, you can see actually there was a battle that went on at the pivot here before it finally broke lower. All right, so extension beyond the average, if you can get a good entry, you have a very good shot, a good probability of getting back to the midline, even if you have the direction wrong. Oftentimes you find that you found the low of the high of the day, as we did up here. So when you take this short, you know, you're not expecting necessarily to get the high of the day. You're just expecting to get back to the midline. And then when you fall through, now you just hang on and follow your rules, follow your trade management rules. You'll end up getting out down here, or maybe here. Okay. All right. How are we doing on time? 13 minutes. So let's switch back to the presentation. Maybe. There it goes. All right. So at this point, this marks the end of my prepared material. So I'd like to thank you for your time and attention. I hope you found today's presentation enlightening. Now, I recognize that we just went through one day in a couple of trade setups in a very rapid fashion. And that's really not enough information on the trading program for you to understand how we take the concepts we've been talking about, implement them practically. So the view here is very holistic. We're identifying that market biology, our biology, is something that we need to work on, and then we're looking for that same biology being expressed in the market, and then that's when we're entering. So unfortunately, there's simply not enough time to go through the principles and the core concepts and show how you practically apply it. So what I have to offer you is a free trading program tutorial that I use here at therationaltrader.com. And that's scheduled for this Saturday at 11 a.m. Eastern, 8 a.m. Pacific. And what we'll do is we'll go through a sort of an accelerated version of the trading program tutorial. It's scheduled for 2 hours. We usually go 3. It will be recorded, and a link will be sent to you later in that day. It is a full HD recording, so you won't have any quality loss. So if you can't make that time because of schedules or other interesting things you saw today that you want to attend, sign up anyway, and you'll get a they should be sending you the link now. Okay. So that trading program tutorial is free. There's no cost. My goal here as the founder, well, with this service, when I started this business, what I wanted to do was make it easy for people to try, to remove the barriers to entry. And one of those barriers is cost. And so when you were looking at the live charts, the indicators that you see there, those studies, there's no cost to you. Those are free to you as a subscriber. All right, that's a big problem I see with the trading education industry, is that there's often a big upfront cost to get started, and I want to remove that. So today was intended to introduce you to the concepts. Saturday's tutorial will show you in detail how we practically apply them in the markets. All right, every day. How are we doing on time? So we have 10 minutes. So I did well, leaving us enough time for questions. And okay, so so any questions, feel free to type them in at this point. It was Jungle Book was the image from that movie with the elephants. That's the old the old veteran elephant going, discipline, that's the thing. Looking at questions here. Actually, not many questions. No. So the question is, are these indicators available for the swim? No, they're not. I support Sierra Chart and TradeStation. Well, so SR is asking, does your method focus on the biological or the psychological? And they're actually the same thing, okay? So I actually don't like the term trading psychology because it conjures up images of you know, sitting or laying on a couch, right? Talking about your problems with a doctor who's helping you to understand the flaw in your thought processes. Okay, there is no flaw. You're not broken in any way. Your body is reacting the way nature intended it to. And your job is to understand that and retrain your biological system. That's what you have to do. So there's nothing wrong with you. It's just that your behavior is inappropriate to the circumstance. And in fact, the markets have specifically evolved to take advantage of that. Shiva is asking, or Raj is asking, did you personally go through these human aspects of what you explain as a trader? Absolutely. 2 or 3 years of extensive pain and suffering, courtesy of the markets. Before I had that epiphany, before I understood that, you know what, it's exactly like the martial arts. You have to deal with that fear. And as soon as you understand that, for me, I can see the structure now that I need to have in place. Rigorously define what you need to do, and then work to do it. It's really hard to do by yourself. All right, so when you've got, that's why you need the guide or the mentor. And in trading, it's especially difficult because you're also trying to figure out technically what are you going to do, what technical method are you going to use, and you have to do it in the live environment. Right? So which we already discussed, right? The live environment makes it extremely difficult to learn. Those people want you to fail. You don't have a training partner, and it's really inefficient because you can't practice that like you can with something physical, like in the martial arts. You can practice that block, that technique for blocking a punch. Just have 10 people do, sets of 10. You'll get 100 practices in. You can't do that with trading. When you look at a chart, there's really only a couple of good entries a day. And so you have to wait for those and then practice your trading skills. It's really hard to do because while you're waiting, you are trading. You're being tempted by the market. But patience actually is the most important quality of a trader. Patiently waiting for a good trade setup. And when you get it, you have to execute without hesitation. And then patiently waiting for the trade to work itself out. More questions. I was trained in the martial arts before I became a trader. Yes, I've been a trader for 7 or 8 years now, but I've been a black belt for about 20. No, I don't support Ninja Trader, Rick. Just Sierra Chart and TradeStation, and there's no plan to support Ninja Trader. Other questions? How are we doing on time? 5 minutes. I did well. Normally I run out of time. Though in truth, I have to thank TradingPub for giving me an hour and 15 minutes. That's a good amount of time to get the material across and still leave time for questions. So I encourage you to, if what you heard tonight resonates with you, then I encourage you to join me on Saturday and see how we take what we've talked about and practically apply it. Okay, so it's it's just like anything else. You have to understand the theory before you can understand the practice. So Saturday's webinar is about 10 or 15 minutes of conceptual stuff, and then the 2.5 hours of this is how we find the emotion in the market. This is how we find that little guy, or how we identify what that big trader is doing and then find a good entry that's still safe. Right? Again, it can be difficult to figure out what the big guys are doing, and when you do, you still have to deal with normal price variations because of the random nature of the market. The market actually it's a very complex system. The output is very simple. The output is a price. But the input is enormously complex because there's so many, there's tens of thousands of inputs. And so that causes lots of price fluctuations, just normal, what looks like random variation. Yes, the tutorial on Saturday will be recorded, okay, and it'll be available for, I usually leave it up for about a month, okay, so you'll have time to watch it. Other questions? You don't need the indicators of the studies for Saturday's class. I'll be displaying them all. If you have AT charts, you can actually contact me and I can authorize you to use them, or Sierra chart. And then you can follow along if you want to. That's not a problem. Other questions? TradeStation is supported. I don't have it. Chris, I don't have TradeStation launched right now. It looks a little bit different because TradeStation's graphics are a little different, but everything that you see here is supported in terms of the strong tick push and the extended move reversal trade setup. There's actually several others that I'm not showing because it gets too complex to explain in this kind of webinar. We'll go over those on Saturday. I do not do options, Brock. I trade futures. Futures are, I think they're a good vehicle to learn how to trade because they allow you to start with a small amount of capital. You're welcome, SR. I'll see you on Saturday. The channel, David, that channel is a Keltner channel. It's 30 period length and it's 1.5 ATR. So 1.5 ATR means these bands are 1.5 average true ranges from the midline. It's a 4-tick range bar chart. Other questions? And we have 1 minute and 50 seconds. I'm very pleased with myself. Actually, I think I got to give credit to TradingPub for giving us enough time. I live trade every day from the gold market open at 8:20 a.m. Eastern until noon or 12:30 Eastern. So I trade the morning session. So we start. For me, I'm on the West Coast. We start at 5:20, trade gold. Then oil opens at 6. That's 9 o'clock Eastern, 6 a.m. Pacific. The stock market opens at 6:30, and we trade until 9 or 9:30. Are you a 3-hour trader? I think you're asking, do I just trade the morning session? Almost always. The thing is, if you take a look at, like, say this trade here. Now, depending upon how many contracts you have, how many contracts you're trading, you're going to be in this trade all day. All right. This here actually is the pullback that you want to add to this position. All right. So on a day like this, we're not ending at 9. Because this is really active, and we're gonna stick around looking to see if we're gonna get this turn or not. This very much looks like you're going to fall and then pull back. You don't always. Sometimes it just keeps going. All right. So if I have a trade on still, then what I do is I just keep the room broadcasting until that trade is either realizes the target or is stopped out. The Saturday webinar is 11 a.m. Eastern, 8 a.m. Pacific. And I have no time. Thank you very much for attending. I appreciate your time and attention. And Raleigh, Yana, Cam, and the entire TradingPub team, thank you.
The psychological